All right, today we're talking about the concept of 2 and 20, which is how venture capital partners, hedge fund managers, and seed fund managers get paid. The concept is called 2 and 20, and it refers to the percentages that they make. This is important to understand as an entrepreneur because until you understand how these managers make money, you won't really be able to explain their behavior. Once you understand how they make money, a lot of what they do becomes a little more clear. 2 and 20 refers to 2% of management fees. That's a percentage that they typically make on their fund size, and 20% of the profits that they make from their fund. So I'm going to walk through a very quick example of how 2 and 20 might work. Remember, this applies to VC funds, seed funds, hedge funds, any sort of institutional investor that gets limited partners to agree to this payment system. So remember, each of these funds, they're generally not investing their own money, they're raising money from limited partners. And so limited partners are their investors. And if they make 2% on management fees and 20% on profits, which is where 2 and 20 comes from, the limited partner, who is their investor, makes 80%. So that's how the investors make money. In these types of investment vehicles, they tend to be high net worth individuals, pension funds, wealthy families, compensation funds, things like that are allowed to invest in this type of asset class. So that's how the limited partner makes its money. 2 and 20 is how the general partner make their money. And that's the 20%, this piece is referred to as carried interest. The street calls that carry. So whenever you hear someone say, does that general partner have carry in that fund, what they're asking is, do they get a percentage of this profit? So another important thing before we go into the math is that these profits are taxed as long-term capital gains. So it's a huge advantage to these partners that it's not income. And that may change here relatively soon depending on what laws are passed. But right now they're long-term capital gains. So we're going to look at the Hasselhoff Fund. The Hasselhoff Fund has 4 general partners, okay? And each of those general partners splits this 20% profit evenly, so they're all going to get 5% of the profit, okay? And just like a company, often this 20% of carry, this 20% carried interest will be split across the employees of the venture fund. So the general partners won't be the only ones that have carry in most funds. So let's look at an example here. The first fund size that Hasselhoff Funds raises is $100 million. And they start operating that fund. So every year, in year 1, they get 2% of $100 million. They get $2 million just to manage their company. Office space, travel, research, salaries. This is just the overhead for a venture firm. That would be year 1, and then this continues on each year until the end of the fund, which would generally be around year 8. So they'd get $2 million every year. So somewhere around year 6, they're probably going to go out and raise another fund, a second fund, and let's say they're doing well, so they raise $150 million. Well, this fund has a $3 million management fee associated with it. So in year 6, they're going to get $3 million from Fund 2 and $2 million from Fund 1. They'd have $5 million to operate their company. Ostensibly, they would need to hire more employees, maybe some more investment professionals in order to maintain that level of investment. That's the idea. Really, there's some argument from the investors that this is just simply that they're getting a raise, more or less. So you can see how this continues from year 6. This one, if it had an 8-year duration, would end in year 14, and probably in year 10, they would raise another fund, Fund 3, and if that one's $200 million, you'd get a $4 million management fee associated with that. So you can see how these sort of overlap one another, and it gives the venture fund money to operate and pay salaries. Not uncommon for a general partner in a $100 million fund to make $400,000 or $500,000 just in salary. Because the operating costs of a VC fund and certainly seed funds are generally not very high. It's personnel, office space, research, and travel budgets. Hedge funds can be a little different depending on what sort of assets they invest in, but that's generally how management fees work. So remember, 2 and 20, that 2% is management fees, and it simply means 2% of the fund size every year in management fees to the company. Okay, so let's talk about the 20% of carried interest or profit. This piece is the most important piece because that's where a lot of the big upside sits for the general partners. So this is going to be very, very simplified, but if in Fund 1, which was a $100 million fund, after they invest, they return $150 million back to the fund. So remember, the way that that happens is they go through exit events. They'll either sell the company or it'll go public, and they will return this money to the investors. So the first thing that happens is you take $100 million out, that was the fund size, and you're left with $50 million in profit. So if you have $50 million in profit, 20% of that goes to the general partners. So that would be $10 million would go to the general partners. This would be not a very good fund in terms of performance. If you looked at what's called the internal rate of return, or IRR, over time, it's not huge, but I'll just use this because the numbers are easy. So if $10 million went back to the partners, and you've got 4 general partners, they each keep 5% of the profit, remember? So if $10 million divided by 4, that means each partner would get $2.5 million in bonuses. And that may be spread over time as the money trickles in from various exits, but that's the basic math. Is the profit on the fund was $50 million, the partners get 20% of that profit. If there's 4 partners and they split it evenly, you can do the math, they'd end up with $2.5 million out of $50 million in profit. So let's look at Fund 2. Let's say in Fund 2 that these guys make one really amazing investment. Let's say they invest in Google, for example. So Google took $10 million in venture money, that was the investment, and when they went public, the venture fund owned, let's argue, 10% of the company, which would not be uncommon and not be an outrageous number. So for that $10 million, they own 10% of the company IPOs for $1 billion. So 10% of $1 billion, this is $1 billion at IPO. So 10% of $1 billion would be $100 million. Okay. So this deal alone returned most of that fund. So let's say that their other companies did pretty well, and in total they ended up getting $300 million back to their partners. So minus $150 million, you end up with $150 million in profit, and we can apply the same mathematical metrics. So you've got $150 million in profit, you take 20% of that, which returns to the partners, that's $30 million to the partners, divided by 4. So that's kind of how the dynamics work. The important thing to remember here is they get paid 2 ways: management fees and profit. Management fees are 2%, profit is 20%, hence how it's referred to as 2 and 20. Very important to understand if you want to understand how venture managers, hedge fund managers, seed fund managers, how they make their money, and hence where a lot of their behavior comes from.